whether you're a seasoned business owner that has been running your own business for the last 20 years, or a new business owner that jumped into the world of entrepreneurship to see where it leads you, there are 7 common mistakes that I see from both types of business owners that can cost time and money when it wasn't necessary in the first place. You can learn what these 7 mistakes are through years of trial and error, or by watching this video so you're prepared without having to go through the trial and error, nor having to pay for your mistakes with your time and money. This is going to be one of the most valuable information that you will come across, so stay with me for the next 10 minutes or so, because this will be worth your time 100 times over. Let's get into the first mistake that I see, which is thinking high income comes with high taxes. When you start earning higher income from your business, 500K, a million, a few million, you're naturally going to be in a higher tax bracket, which does come with higher taxes. While that is true, the mistake here is thinking that you're stuck paying the increased taxes. The truth is, there are ways for you to lower the income that you pay taxes on by strategically planning and implementing tax strategies that apply to you and your business. The majority of business owners have a tendency to run their business on autopilot because they're too busy running their business to think about taxes before it's too late. I've found that they're also afraid to take the next step and invest into a strategic tax plan because they don't know what to expect from it, when a strategic tax plan will ultimately help them keep their money where it belongs while growing different sources of income and their wealth. If you started sweating while listening to me because this sounds like your situation right now, take this as a calling to take action. Reserve Tax Advisors identifies all the unique opportunities for you to lower your taxes with tax strategies that apply to your specific situation. Our tax analysis will uncover the savings that you've been missing out on and will guide you along the way to make sure you keep the most money legally possible. Schedule a free consultation call and we'll discuss how we can bring your taxes back under control. The link will be in the description. Now, let's get into the second mistake, which is business owners not separating business and personal expenses. There is very limited tax information on social media that is actually correct, which makes it extremely difficult for someone to know what is factual or not. Let me clarify everything for you and just give you the facts. IRC Section 262A specifically states that personal expenses are not deductible, but the tax gurus on social media like to think they're geniuses and try to stretch this in ways that doesn't make sense. So here's what you actually need to know. When it comes to personal expenses, it comes down to the reasonable usability of the item for personal use. This would mean that any expenses that can also be used for personal use are considered personal expenses and cannot be deducted on the business return. Now, the most common expenses that fall into this category would be things like clothing, haircuts, jewelry. I remember seeing a video on YouTube a while back about someone saying that a Louis Vuitton bag is deductible to the business because they carry their laptop in the bag. This is dead wrong for a few reasons. IRC 162A states that you can deduct expenses that are ordinary and necessary for the business. Luxury items can never be considered a business expense because it isn't ordinary nor necessary for the business. There's no reason that you absolutely need a Louis Vuitton bag instead of a plain laptop bag, which serves the same purpose. A Louis Vuitton bag is also suitable for personal use, which falls under IRC Section 262A, therefore making it non-deductible. Another example of this would be another video I saw a while back where a tax guru was talking about writing off their $5,000 suit because they have their logo in the inner lining. Again, this would be dead wrong because clothing is not deductible in general unless it is strictly a uniform. A suit is also suitable for personal use. No one is going to see a tiny logo on the inside of your suit, nor would it make the suit unusable for personal purposes. Even if you were to strictly use a suit for business purposes, it's not deductible because it falls under IRC Section 262A and is considered a personal expense. Now we move on to the third mistake business owners make, and it is continuing to operate as an LLC when you are making over around $60,000 to $70,000 or so in net income. This one mistake alone can cost you tens of thousands of dollars due to an unforgiving 15.3 self-employment tax that you're paying every single year on every single dollar that you work so hard to earn. I have a video on how S corporations work, and we'll have it in the description if you want to check that out. Making the S-Corp election to be treated as an S-Corp for tax purposes would put you in a much favorable position because you get to pay the 15.3% self-employment tax only on the salary that you pay yourself, while your distributions are free from the self-employment tax. This one change alone can save you tens of thousands of dollars for you to grow your business instead of working 3 to 4 months every single year just to end up having it disappear to taxes, never to be seen again. How sad is that? Don't ever put yourself in that position. And if you want to evaluate whether an S-Corp election would be the appropriate move for you to make, schedule a consultation and we can give you the insight you need to make a wise decision. The fourth mistake business owners make is thinking that finding all the deductions is going to lower the taxes. When you get to a certain point in your business where it generates a few $100,000 of revenue, a $1,000 deduction isn't going to move the needle anymore. The real tax savings come from the appropriate strategic planning that is done throughout the year, which can potentially decrease your tax bill in full. Deductions are only a small piece of what decreases your taxes. The real needle movers are the different strategies such as the Augusta rule, cost segregations, short-term rentals, accountable plans, children on payroll, and so on, which require careful planning, documentation, and execution to have successful results. The fifth mistake business owners make is poor documentation. For any and all business deductions or any business moves you make, you need proper evidence to back it up in the case of an audit. Whether it's meals, vehicle deductions, or supplies, you should be ready to show exactly what was purchased and why it was purchased at any time. A credit card or bank statement is not sufficient because it only gives the amount and the merchant, but no information as to what was purchased. So be sure to have receipts on file in case you ever need it. Every expense that the business incurs should have a bona fide business purpose to be deductible. You need to remember, you are innocent until proven guilty in court, but it's quite the opposite in an IRS audit. The burden is on you to prove that any and all deductions that you take are legitimate business expenses, which starts with having the necessary documentations to back your claim. If you fail to back up any deductions or strategies that you've implemented, the IRS will end up reversing that decision and you will end up with penalties and fees along with increased taxes that you will now have to pay. So the sixth mistake that business owners make is ignoring estimated taxes. Estimated taxes should be paid throughout the year instead of as a lump sum at the time of filing of the return. If you expect to owe over $1,000 in federal taxes after taking into account all the credits and all the withholdings, you should be making estimated tax payments to avoid the underpayment penalty that you will incur if you don't pay it. You can avoid paying the underpayment penalty by meeting the safe harbor rules for estimated payments. The safe harbor rules go like this. You should pay at least 90% of your current year tax liability or 100% of your prior year taxes. If your AGI or adjusted gross income is over $150,000, the prior year rule becomes 110% of the prior year taxes instead of the 100%. You should make these timely payments on April 15th, June 15th, September 15th, and January 15th. Making timely payments that meet the safe harbor rules will ensure you don't get the underpayment penalty. Tax projections with your advisor is incredibly valuable to determine exactly how much you should be paying in estimated payments so you don't pay less than you're required to, but also so that you don't pay more than you need to, because that will only end up tying your money up for the year, even if you do end up getting the overpayment back as a refund. You should always aim to not overpay any taxes because it just ties your money up and you lose opportunities that you would have had otherwise. The seventh and final mistake that I see business owners make is making major purchases without having the proper planning done for the most favorable outcome. Whether it's a machine, a vehicle, a rental property, proper planning before making the purchase is crucial to having the best results to take advantage of opportunities such as depreciation timing, Section 179, bonus depreciation, cost segregation, financing structure, and so on. If you're looking to make a major purchase, having a team of experienced advisors to structure the purchase properly can ensure you get the best results for yourself and your business. And again, this is something that we can help you with. Being in business is an exciting adventure for any entrepreneur, but there are countless entrepreneurs that have made many mistakes along the way. You don't need to be a part of that statistic when you have a proper team guiding you so you can continue to do what you do best while making sure you avoid all the mistakes that most other business owners make. If this video has helped you out, please subscribe and hit that like button as it really helps us out a lot. And be sure to leave a comment with any questions you have, and I'll be sure to get to you as soon as I can. That's going to be it for this one. Thanks for watching, and I will see you on the next one.